Hi, everyone. Welcome to another webinar for YX Insights. Today is Tuesday, September 24th, after the market close. So today we're going to just go through a few things related to the Fed. We're going to do a little recap, and then we'll look at the yield curve and the trade setup in TLT that we triggered last week. And then we go on to do some liquidity analysis and the impact of liquidity on bonds as well as stocks. And then we dive into the chart analysis. So I think the first section of this webinar will be a little bit shorter than usual. And then we can spend more time on the charts. All right. So on Wednesday last week, the Fed cut rates by the Fed funds rates by 50 basis points, which was, so going to the meeting was a 50-50 decision. It was very close. But I think 90% of the economists expected a 25 basis point cut because the data since the data in September were largely okay. Actually quite benign, both in terms of non-farm payrolls and CPI and the retail sales as well. So that actually raises a question on why the Fed cut 50 basis points, why they seem to be in a hurry. Obviously, there are a few explanations for that. One, they didn't cut in July, so they could be just doing a catch-up. Second, they're actually scared of an incoming recession, even though they don't admit it. And third, they are just being held hostage by the bond market pricing, or rather, maybe they don't have they have a more neutralish view on the outlook, but they feel like the bond market knows something they don't. And very often, the bond market is ahead of the curve, and the Fed is usually behind the curve, and the Fed doesn't like to be behind the curve. This is the updated dot plot from last Wednesday. So before in June, this used to show just one cut, actually mostly 1 to 2 cuts. Now the median does suggest 100 basis point of cuts by the year end, including the 50 that was done in September. So 100 basis point is a quite drastic change from the 25 basis points we showed in June. But kind of in line with bond market pricing. So bond market was pricing around 120 basis points. So sort of in line with the bond market pricing. And then next year, another 100 basis point of cuts. And then 2026, the cycle finishes. So that's what the Fed thinks right now. I think they've lost a lot of credibility in the way they've done dot plot this year, from 3 cuts to 25 basis points to 100 basis points. So actually, it's probably more helpful just ignore this altogether and just focus on what the bond market price is going forward. And what concerns me is that so the Fed wants to cut 200 basis or nearly 250 basis points in the next 2 years. But if you look at the projection for real GDP, it doesn't change for the next 4 years, 3-4 years. Rather. And so all else equal, if you have looser financial conditions, lower interest rates, it should boost growth, right? If the Fed didn't think there was a recession coming, theoretically, if they did a really aggressive dot plot revision, they should expect higher growth rate in GDP. Also, unemployment rate, again, gets worse in the near term and held at 4.4. And then stays at 4.2. So we're at 4.2 today. So essentially, the Fed thinks cutting 250 basis points will help the unemployment rate to stay where it is today in 3 years' time. Again, inflation we know is on the trajectory of getting to 2%. So what this really is saying is that Fed wants to cut aggressively just to maintain the same pace of growth and same status quo. That means all else equal, they actually think there would be a recession coming if they didn't cut as fast, or if they didn't cut as steeply in the next 2 years. Very funnily, Powell basically refused to say what's changed in June, since June, that made him want to cut 50 basis points. And he says, we are not behind, we're timely, and actually this 50 basis point cut is a commitment, is a sign of confidence and commitment to not being behind the curve. Unfortunately, the last two times, so prior to the meeting, we showed loads of scenarios of the previous Fed cuts, the three cuts in 2019, or 1995, 1998, and the markets rallied significantly afterwards. Unfortunately, when the Fed started 50 basis point cuts, inevitably we had recessions in the last two cycles. One is in 2007, the great financial crisis, and 2001, which was the dot-com bubble. It is really interesting parallel because it doesn't feel like we are in the 2007, subprime mortgage crisis. It doesn't feel like the house market is running away into all-time highs and everyone's going crazy. It doesn't. The general macro feel definitely feels, yes, we have high GDP, but households are feeling tightish on their budgets and spending. And it's quite hard to draw the same parallel. But when we did cut 50 basis point on precisely the same date, September 18th, 2007, we had an initial rally in the first 30 days because bingo, the Fed cut big to avert recession, market rallies. But then if you look at the following 1.5 years, stock market returned, SPY returned negative 40%. Again, 2001, which was a dot-com bubble, which does feel a bit similar, more similar to today with the AI stuff and the narrow and the concentration of stocks that are outperforming the market. But again, so the difference is that going into the first 50 basis point cut, the stock market was already down 20% in 2000. So in January 2001, the Fed cut big, and they continue cutting big, essentially to just like below 1% in the next 2-3 years. And we had the stock market essentially going down to by 30% in the next 3 years. So both very bearish events in the medium to long term. So if the Fed is actually really worried about recession, and it doesn't really look good for us, even if we had this little rally up front. And if we just compare the unemployment rate, actually in 2007, unemployment rate was 4.6% when they started cutting. And so today it's 4.2. And it stayed below 5% for 3-4 months. And then it just broke away after 6 months. And we had, again, the non-farm payroll actually started off quite promising, like up 100K for a few months, 2 or 3 months. And then it just became it became a massacre in the job market. 2001, unemployment rate was sub 4% to start with, actually. So even better than today. And it went up rapidly towards 5.5% and then 6% in the next 2-3 years. But non-farm payrolls actually bottomed. Well, when I say bottom, it's still printing negative figures for 2 years. But the worst was a year later. So in either of the scenarios, the worst is yet to come, which is basically not very good for us. I'm not saying currently we are in 2007 and 2001. GDP doesn't suggest the scenario. We have, GDP is on track to 2% this quarter, 23% last quarter. But in terms of non-farm payment, the labor market has softened a lot from 3.4% to 4.2% now in unemployment rate, and non-farm payrolls is printing, just around 100K and sub 100K in the previous 2 months. So things can change very fast. We have to be very cautious. So I would say optimistically cautious. Hopefully the Fed can actually avert an incoming recession that if it were to happen, but we just have to really watch the macro data to kind of assess what's going on. after the meeting. So the terminal is done. November, market again prices 50% chance of 25 versus 50 basis point for November. So for the Fed now sees the projection, the dot plots basically says 25 basis point cuts in both November and December, because the pricing 100 basis point cut, we've got 50 done already, so 25 in each of the next two. But the market thinks there's 50% chance of 50 basis point cut in both of those November, December meetings. And actually for 2024, instead of 100 that's projected by the Fed, is 130 basis point now, 35 basis point now projected by the market. Again, January, the market is still pressing on for a bigger cut in January than 25 basis point, more than 50% chance for a 50 basis point cut. So we could actually have 3 consecutive 50 basis point cuts in the next 3 meetings. And it's a very realistic chance. But what's interesting, what happened is that the terminal yield actually went up by 10 basis point priced by the market from 2.73 to 2.85. So it's actually the curve steepened. And I'm going to talk about this in a second. But basically, the market thinks the short-term rate cuts will be much more aggressive, whereas the longer-term yield might actually rise. And I think what the market is actually pricing, so what that really means is that they think the Fed will go really fast and hard, and actually maybe we won't have a recession. We won't have the 2007 scenario. Because really this is saying we're going to get to the neutral rate of something like sub 3%, but no more than that. So if you look at back to 2007, right, we're having the cumulative action of Fed basis point. We had 500 basis point cuts and 550 basis point cuts in each of those 2 cycles. The market is not saying that. The market says we get from 5.33 before the last meeting to 2.85, which is 2.5% cut in the next year, and we stay there, right? So no, it's basically soft landing scenario. We had this trade on TLT trade invalidated. In fact, yesterday I sent a message to the group chat saying the market printed a low of 98.02, which is just above my stop before we got this bounce intraday. And over here, I decided to stay with the trade. The reason is we could have easily faked out over here. And here was still like a support zone here. So I just let the trade do its own thing instead of trying to stop out manually. Today, before the market opened, we breached the $90 level. And I think we may have a further, so if we got 1, 2, 3, 4, we might have a 5th wave down to 97 level. So, and plus this curve steepening observation I made, which I'll explain in a second, on the balance, I think it's better to stop out this trade and just reassess and see where things take us. But in the long term, even if we get a retrace here, I do think TLT will go higher in the long term. And I think that's because the first technically is pointing higher. So that's just the chart logic for now. But if we look at where this chart ends, which is wave 5 here at 130, that's 30% above today's level. It projects a 20 to 30 year bond, specifically 30-year bond, to 2.1%, which was the level we had in 2019, and it went obviously below that during COVID and then bounced above, etc. But that level is actually really realistic and achievable if we get to the 2019 scenario. It would imply that we have a recession like in 2007 and 2001, and the actual neutral rate is, so the Fed thinks the neutral rate is something like 3%, but actually the neutral rate is way lower, like 1%, or between 1 and 2%. So I think Is that right? No, it will be something below 1% because the real neutral rate would be below 1%, and we have 2% inflation or even sub 2% inflation. And it can happen basically if we do have a recession. I think the risk is quite balanced here. I don't think the recession is completely out of off the table like the futures market is pricing right now, because what the Fed thinks is seeing, but also the yield inversion that we saw before and the sum rule. So there's definitely at least a 50% chance of a recession happening. So I still like TLT in the long term. In terms of the direction, even despite short-term retrace. So since the FOMC, and now we're going to talk about the curve steepening. What's happened is that if you look at the bond outright yield, the 1-year bond fell by 7 basis point. Since the FOMC, I snapped the yield curve before the FOMC. 2-year fell by 3%, but actually you look at 3 to 30 year, they all rose. So when the longer end yield rises and the short-term yield falls or doesn't rise as fast, it means the curve is steepening. And if we look at the forward tenors, we touch on this in August, but it's just a recap. The forward, so this is outright. So this, if you borrow money, if you lend money to Treasury for 10 years, you will get 3.8% every year for 10 years. 5 years every year for 3.5%. But let's say if you want to lend money to the Treasury, not from today, but in 3 years' time for 2 years, that yield is different to this 5% to this 5-year outright yield. That yield will be something like 3.57%. And again, if you're looking at lending money in 10 years' time for 20 years, that yield is 4.3% in terms of forward starting dates, not 4.1%. And the math is quite simple, actually. It's just that if you think about, if you lend the money for 10 years at 3.7%, but if you lend money for 30 years at 4.1%, which means it's more expensive to lend money in the future after 10 years, then the forward rate would be much higher than 4.1. It would be 4.31, and to balance out, to give you to balance out the cheaper 10-year yield and give you the 30 yield at 4.1. But all that is to say, so the whole point is not the math here. The whole point is that the forward rate has steepened a lot. They've gone up a lot, 16 basis points for the longer term dates. That's a really big move. And it's a really big move because everyone's now betting on this yield normalization or reversion or an inversion, as you call it. So basically, people think the yield curve should normalize into a normal shape. Sorry, I can't draw on the screen, but the longer term bonds should be yielding higher than the short term bond. So before the FOMC, we had, or before September, we largely had 2-year yield higher than the 10-year yield. As you can see, the 10-year, 2-year spread is in negative territory. But since the beginning of September, we've crossed this parity where the 10-year yield is higher than the 2-year yield. And it's not a really good thing for risk assets, because traditionally, if you look at the past few recessions, every time this curve starts normalizing or reverting above zero, we had a recession in a few months' time. So not this quarter, but maybe the quarter after and the quarter after that. If we look at this is the 10-year versus 3-month, it's also starting to steepen a lot, but it hasn't crossed to zero yet, which gives us a little bit of time about the recession thing. Because usually it's after this curve crosses the zero mark, we get a recession. The 3-month versus 10-year is slower than the 2-year versus 10-year, because the 3-month rates moves last, right? So the 2-year already has rate cutting expectations rate cutting expectations, whereas the 3-month really is only affected by the Fed cutting rates physically. So it will happen much slower than the 2-year spread. This always happens, which is a bit annoying. And just to get back to this, and just to visualize that changing curve, this is that outright bond yield. You can see that the blue line is before FOMC, the yellow line is now, today. The far end, the outright bond yields have gone up, whereas the shorter end has gone down. So hence that's the steepening. The curve has steepened over here. And again, this probably visualizes better. The fall for the rates have gone up. The curve has gone steeper, whereas the previous curve is flatter, is closer to the x-axis. So I think the play right now is sophisticated investors would do something like they would go long the 2-year treasury and short the 10-year treasury to keep pushing that curve steeper. And they would do it on a duration weighted basis. Duration also just basically means the impact of 1 basis point, the impact of 1% move in rates has a, let's say 12%, let's say something like 8% move on the 10-year treasury. So the 10-year treasury duration is not exactly 10 years because of the timing of the cash flow. It will be something like 7.5 years to 8 years. So if the interest rate curve moves up by 1%, the US Treasury 10-year yield probably moves up by 8%. Not the yield, but the price will move by 8%. So the institutional players will do this. Retail players is much trickier. But the equivalent trade would be you long SHY, which is 1 to 3 year bond ETF, and short something like TLH, which is the 10 to 20 year bond. And to keep it duration weighted, so SHY has a duration of 1.8 years, TLH has a duration of 12.8 years. The position size for SHY should be 7 times position size of TLH, because 1% move in the curve, a parallel move in the curve, will result in TLH moving, the price moving 7 times more than SHY. So you really, to do this long short pair trade, you really have to go heavy on the SHY and much lighter on TLH to keep it, so you can do a pure duration weighted curve play. Before I get into liquidity analysis, is everything clear up to this point? I'm going to take some questions now before I get into liquidity, because I think there's quite a bit to digest. So if you have questions, please just unmute yourself and ask away. Okay. So yeah, go on.
Yeah, but is this a trade that you're going to put in the tracker that you would envision setting up yourself?
So this is not a trade I would put on myself. Basically, the math gets quite fiddly in terms of. I could actually, okay. I think I'm not going to put it on myself, but I can put this in the tracker to track it. I think that would be a fair statement. So we can track it in terms of how this plays out. But in terms of execution, personally, it's not easy for me to do this trade because of my basically because that's like a personal account issue. Yeah. But yeah, I can put this in the tracker and we can see how it performs.
Okay, thank you.
Yeah, no worries. But yeah, okay, to recap, in terms of outright levels, I expect short term for like TLT or TLH to further go down in the short term correction. And in the near term, we might have topped already. But in the long term, I still favor them going up. And so what I'm going to do in terms of outright play, I'm going to just wait for the ideal entry and set up. And obviously, I'm going to alert everyone for that. Going on to liquidity analysis. So,
Given I got another question, if I can.
Yeah, go on. Yeah.
Do you ever? What's your take on leveraged ETFs relative to these instruments here, like say TMF, TMB? I mean, I know that those are relative to the 20-year, but But I guess regardless of the time frame, are you hesitant on the leverage ETFs for bonds?
So I think my concern for the leverage bonds or leverage ETFs generally is more of a technical issue. It's not to do with the direction of the trade. It's just that the leverage ETFs, what they do is they have to keep on hedging, keep on leveraging and hedging and deleverage to match the daily movements. And so the 3x is only on the daily movements. And over time, both the bullish ETF and the bearish ETF could lose money because they have to keep on hedging, keep on leveraging and deleveraging each day to get to exactly 3x daily movements. So over the longer term period, it doesn't necessarily perform 3x of the actual, let's say, TLT performance. But in terms of actually the nature of the ETF, they're both TLT and TMF. I understand they both track the same index, which is the 20 plus year US Treasury index. So they're tracking the underlying index. I'm just personally concerned with the mechanism of leveraged ETFs. So I'll just be wary that it doesn't, like over a longer time frame, it doesn't always do 3x or 2x, whatever they state, because they're only really targeting the daily levels. So that's my only concern. It's a technical one. I think the thing is, if I do TLT trade, you can, if you really want to do the TMF trade, it will be the same. It will be the same levels in terms of like Fibonacci levels. So actually, no, that's not true. So because of what I just said, it might not be the same Fibonacci levels, but directionally, they should move the same way. So you can always do that yourself. But I wouldn't cover that in the service. Yeah.
Okay.
Yeah.
Thank you.
No worries. So liquidity. So liquidity has been a funny one recently. We had, so this is a TGA. So TGA is US Treasury account, a general account balance with the Fed. It's basically the government's bank account with the Fed. When this bank account goes high, it means they're not spending money, they're holding money from the economy, through tax receipts, for example, and debt issuances. So this account goes up, and the general bank reserves in the economy will go down, and that's bearish for risk assets. It went up quite a bit last week, from the beginning of last week, actually. It's come down slowly, but overall, compared to the week before, we're still at elevated levels. And I think this really echoed, when we talk about liquidity issue at the beginning of the month, and we said that liquidity in the second half of September will be challenging, and it is really shown here already. So in terms of reverse repo levels, again, that level's gone up. Reverse repo level, you can think of it as money market funds parking money with the Fed to get interest. They're lending money to the Fed. But when they lend the money to the Fed and it stays in the Fed's balance sheet, it means there's less money in the in other markets like the Treasury markets. So what usually happens is that Treasury yield tend to go up when RRP volumes go up. Because there's less demand for treasuries. So if we compare this, so the blue line is the overall Fed liquidity, Fed balance sheet minus the TGA, I should show the reverse repo plus the bank term funding program. Usually an inverse relationship with the 10-year Treasury yield, and he's been pretty much. I mean, they're both going down, but if you look at the micro level direction, they're also inverse with each other. So worse liquidity in the past week has resulted in yield going up, spiking in the past month, which also was disadvantage to our trade actually. So the curve steepening plus worse liquidity conditions have put a lot of pressure on the 10-year, upward pressure on the 10-year yield, and therefore it was bearish for things like TLT. However, it has not had the intended effect or expected effect on the stock market. Largely, the liquidity went up beginning of last year, and the market went up. There seems to be a lag. But basically from the yen carry trade unwinding, there was a decoupling over here, and also decoupling over here. I think over here we had them moving in the same direction, but again, the stock market is very, very bid, actually much more bid than I expected before the FOMC, while the liquidity has gone up. So I think there's a few explanations. This could be a leading indicator of stock market, because usually if you think about liquidity, it usually works through the treasury market first, buying up bonds, and then the excess bank reserves gives banks more room to get into more risky activities like equities. So there could be a lag effect, as you can see here. It turned down first, and then stock market turned down a month later. But also there could be because the yen carry trade is back as well. So because the 10-year yield has gone up rather than down since the FOMC, what could have happened is that the yen carry trade has become more lucrative than before the FOMC, essentially. So this line here is, so the candlesticks is QQQ, and this line here is the spread between the 10-year treasury yield of the US versus the Japanese 10-year treasury yield. So when the spread tightens, the carry trade is less profitable because they're picking up less yield from the US leg, and the cost of borrowing is higher in Japan. So the profit margin is squeezed, so they have to unwind the trade, which they did over here into from August. So it fell here and also here as well. But now the 10-year yield has gone up, which drives most of the spread because the Japanese 10-year yield is only like 1%. So it doesn't really move that much. Japan started not to raise interest rate again last week. So most of the action is from the 10-year yield. Eric, do you have a question? Okay, no worries. So I think most of the action comes from the US leg. And so all of this makes me think that some of the carry trade could be back as well. So this is another thing we'll have to watch closely when this decouples. And finally, the third possibility is that China recently essentially opened the floodgate on stimulus. And we can see that, and also Eurozone cut rates before early in the year. So we can see that this is the global liquidity index that accounts for US, UK, Eurozone, Japan, China as well, Australia, like global central bank balance sheets. And you can see that has turned up more recently, despite the Fed liquidity turning down. So this could also have had a positive impact on the US market. But so out of all three, I think this and this are equally possible. In terms of lag and the yen carry trade being back on are equally possible. I think this is slightly less possible because China is really in a bad situation right now. So it is actually not that clear whether the stimulus from China even has enough of an impact on its local economy yet before driving this US stock market. I think there will be a significant lag between liquidity in China coming to the US market. And also, typically, if you global liquidity moving up should also have a positive impact on things like cryptocurrency assets, which I mean, Bitcoin has been a bit more bid more recently, but past few months, it's just not gone anywhere. So this third option I'm not that sure about, but it's still a possibility that I just need to present. And just zooming a bit more into China. So yesterday, the People's Bank of China lowered the 14-day reverse repo rate by 10 basis points. Also injected 74 billion liquidity into the banking system. So that's something like $8 billion or $9 billion. And today they lowered the 7-day reverse repo repurchase rate from 1.5%, to 1.5% to 1.7%. And this is the lowest level on record since 2012. So the government is really trying to do everything to basically avert a potential recession. They claim to their target is 5% growth in GDP, but it's very likely they will miss it. And so today they held a press conference about the rate cut. The three key messages, apart from the rate cut, so they're going to reduce the bank reserve requirement ratio by 50 basis points, which will free up 1 trillion yen or $140 billion for new lending. So very similar, so if you think about this, is essentially freeing up bank reserves. The banks don't have to tie up as much capital for regulatory purpose, and they can invest that into risky activities. Mortgage rates and down payments, they're trying to guide commercial banks to reduce the interest rate on existing mortgage rates by 50 basis points. Also, they want to lower the minimum down payment ratio to 15% from 25%, which is quite big. That's almost 40% reduction in terms of actual monetary value. And the reason they want to do this is because there was a real estate bubble, and now China is coming to real estate-led recession. There's a lot of real estate companies like Evergrande going bust, owing banks a lot of money, and people. So they're not actually even completing the houses, and people are struggling economically as well. So they want to hold this sector, because if this sector goes down further, then there will be more essentially defaults in the real estate borrowers. And then they want to revive the stock market. They openly said that, actually, because the stock market in China hasn't really moved. And we're going to see KWEB in a second, but they haven't really gone anywhere for the past 10 years, I think. And the timing of all of this is just before the October 1st, which is the national, which is the national holiday. It's the equivalent of July 4th of America, but in China. So I think the government really wants to push a bullish sentiment going into October 1st, and with the stock market specifically being a target. That's why the Shanghai index rallied 4% today. They've tried this before, the stock market revival, and it ended up, what happened last time was that there was a lot of front running going on, because whoever buys those stocks obviously is bought by people, fund managers, and they know the listing in advance. So what happened? They front run the state buying ahead of the thing, and actually the state wasted a lot of money trying to keep a bid in this market, and the market still didn't really go anywhere. So it's really unclear whether this will be an effective tool this time around. So we're going to move into TradingView live charts now. If you have any questions about what we have so far, please ask away. But otherwise, we can go into the charts. Okay.
So, Yimin?
Yeah, go on. I'll go back.
Yeah, Yimin.
Yeah.
Yeah. So, what are you gonna do with the TLT? You will do another setup, trade setup, or
so TLT. So yes. So what I'm going to do? Are you guys still seeing my share screen on the on the deck, right?
yes?
Okay, cool. So with TLT, we have a close trade here. What I'm expecting, I can show a bit more charts in the live charts in a second. I want to see this 5 waves to complete. And I suspect this will be ABC wave down, and there might be further room to go, depending on how much the curve steepening goes. But that will be more of a judgment call here. What I'm going to do is I'm going to look out for the level of setup over here to play this longer wave 3, essentially. So today's correction is nowhere near enough, but I'm waiting for this to drop further. So to play a more medium term play, essentially. So at the moment, there's no trade set up yet. I just have to wait and assess. The other thing I did say is that I could put on this thing, the tracker. It would be more for the tracking basis in terms of long, short duration play. I would say this is quite fiddly because this is not just like 7 shares of SHY versus 1 share of TLH. This is the actual gross monetary value position, 7 times with TLH short. So you might end up with like 80 shares of SHY versus like 9 shares of TLH or something like that. I did the math today, and it can be a little bit fiddly to keep. But yeah, but I can keep that in the tracker. This might not be easy one because you have to actually put down. So this is quite a big position if you think about the duration weighted play. So it might tie up to a lot of capital. Obviously, bond traders, they only ever need to put on this one trade because they only trade rates, right? They only really need to put on one trade for their entire risk in billions of dollars. Whereas if we're playing stocks, Bitcoin, stuff like that, you might not necessarily want to do this long short trade to tie up your capital, but it's just for informational purpose, I guess. Yeah.
Okay. Thank you, Yimin.
No worries. So I'm going to stop sharing this. And I'm going to share my trading view in a second. I would actually go from this chart we looked at before. So I think I expected it to be the stock market to be more bearish, but then I also didn't think it was 100% chance they were going to cut 50 basis points, which they did. So if we looking at the 2007 playbook, the market reacted bullishly the stock market reacted bullishly to 50 basis point cut. So that kind of makes sense. This is essentially, yeah, I'm just checking. I'm sharing my screen. And this essentially follows the same pattern where after CPI goes down a few days and then curves back up. QQQ. All right. I have revised my chart from Friday because prior to Friday, we only had 3 waves up, which usually means it's a corrective wave, and we would expect something like an A, B, C bounce. But actually, it's been much more constructive since the FOMC, and we had 5 waves up now. And if we look into this, the subwaves, so wave 3 was 1.76 extension of wave 1, and this is all very standard Fibonacci levels. And we're now hitting 2.382 extension. And wave 4 is essentially the same length as wave 1 now. So I think we have enough room to count 5 waves complete. It might stretch up to here to 488. But in near term, I do expect a pullback. And the difference between this chart and what I had before is that I think this pullback won't be that steep. It definitely shouldn't go below, 448. But I think it could land somewhere anywhere between 457 to 467. And from there, we're looking at 5 waves up. And we're looking at a potential wave 3 target of 527. So this could be a trade stop up. Once we have a pullback, we can target 526 level. It could even stretch further to 532. And then we get wave 4 correction at 504. And then wave 5 anywhere between 538 and 550. So that's going to the year end. And I do think its setup is bullish. I have no reason to doubt why it shouldn't be bullish. With the liquidity lag we said earlier, and going into the month end, we could have this pullback, but I don't think this pullback is the beginning of a larger correction, essentially, at this point. So the medium-term view is still intact. And I think after November, especially, maybe a lot of this will happen in the back end of October. After November, the election typically is the rallies are very strong. SPY, the count is not quite as full as QQQ. Again, we had 5 waves up from September 6th low, which is great. I'm always happy if my previous bearish count is wrong, even though I might look wrong, but if we're going up, everyone's making money. I'm always happy for that, obviously. We've had wave 3 over here, 2.38, and a quite shallow pullback. I think this hasn't quite topped yet. I can see at least one more wave up from here to 576 level. Before we get a pullback to here. And again, the pullback should be something like, up, down to the 0.38 level, and then we can go higher towards 600. And this, so I don't see any reason. I mean, this pullback may not be, in November. It could be quite quick and shallow over here. Because we haven't completed those wave 5 yet, so there's no way of knowing or of kind of mapping out how far this will go. But this is kind of my rough expectation for the next 3 months into the year end. TLT I mentioned before. So the reason I've got this 5 wave up, so wave 1 is here. Wave 3 is 1.618 extension, just slightly below that. Very, very standard pullback to this level here. And I think, so given where 1, 2, 3, 4 is, I expect wave 5 to go beyond the 2 extension, below 97.5 and to 96. We could have a wave A, B, C further down, but it's just a little bit too early to kind of speculate on how that will take shape. But again, on the longer term chart, it could very well be, let me just look at where we are now. Oh, sorry, I just need to look at the hourly for a second. Yeah, okay. So April 24th. So I think we've had this up, and we could get retrace to somewhere like 94, 95, and then we move through higher. Yes, that's right. So we move through higher to wave 3, 4, 5. This won't happen overnight. It could happen. It could happen next year because the Fed right now thinks it's still soft landing. The market is still thinking that as well. So we're expecting a retrace here, but before you know it, like when the signs become really clear, we might have a recession, for example, unemployment rate moving really fast, etc. Then the market will be very aggressive in pricing in more rate cuts and bring that terminal yield from 2.8% to something like 1%, which is what happened in 2001 and 2007. So that's my expectation. I just wouldn't hurry yet. So this is the yield curve. So now move on to Bitcoin. For Bitcoin, yeah, go on, Alex.
Yeah, hi. Could you please go back to your previous TLT chart? So my question is, so TLT looks very promising, but this is to your point. This is not going to happen overnight.
Yeah.
And if there is a indication that recession is coming and the rates are going to fall, that's when I guess everyone's gonna like jump the gun and jump to load TLT, right? To like BG.
Yeah.
So would that be the time to get into TLT, or because we are anticipating based on all the indicators that you have shown previously during this session and some of the other ones I have seen elsewhere. If we are anticipating that recession is almost certain, we don't know how deep it is going to be, but there is going to be one. We don't necessarily know the timing. It could be 3 months, it could be 6 or 9 or even 12 months, right? So what is in your mind, and this may be early now, what would be a good time to, load up TLT?
So if you want to, so I would be more chart driven here. I think I think we look at the macro. So I think we have a lot of stuff. We have a lot of pieces of a puzzle fitting together. Mm-hmm. It's not a quite easy thing as say if unemployment rate is at 4.5%, we can start loading up or etc. Mm-hmm. I think in terms of timing, we will, because there's a lot of things we're watching, like the unemployment rate, the data, the data, but also liquidity analysis from the Fed liquidity, and also generally the technical analysis. I think it's like a combination of all of those things. But I think what I would do is I would start looking at what are the good levels here in terms of retrace. I think if we get something like a 50% retrace of this move to 94.6, we can probably start layering, like start with the position, small position, and add over time. And as things develop, I think it's really hard to pinpoint one point here to say that is the bottom or that is the end of retrace, because there's a lot it's a really massive market. There's a lot of things driving this market. So I do think it's a combination of things. What I would say is that with the next election, the policies, the fiscal policies also come into play as well, because in terms of what, if we get trade war 2, that could bring recession quicker, which in 2019 people didn't quite see at the beginning of the year, and they kind of saw mid-year. But actually, with trade war, if we get Trump and trade war 2, we can probably be a bit more aggressive in loading up earlier. Mm-hmm. In terms of expecting further rate cuts. So there's a lot of variables. It's really hard to say at this at the exact moment. I think the GDP stuff is kind of like the last thing we should look at, because that's kind of like very final nail in the coffin that confirms the recession has come. But usually we want to look at, the trending non-farm payrolls, also the technical analysis, the liquidity picture we saw that we track every day essentially. So I think it's a combination of all of those things. Also the steep curve steepening, historically how long the lag has been. So I can't tell you in this webinar right now because I don't know.
No, that's fair. I'm not expecting you to say that, but I think what you just mentioned seems logical. So what you're saying is essentially, layering over a period of, I don't know, like a month, 2 or 3 maybe, and then just wait for that ride. Essentially, that's what it is, right?
Yeah. I think we can look at it. I think I would probably expect this pullback to continue for next couple of months, essentially. So I don't think. I mean, I'm essentially technically, I'm waiting for the 90 to get to below 95. If we get something really shallow, which it could happen as well, I'm not afraid of pulling the trigger sooner either. So we'll just have to watch a lot of things
Okay.
at the moment. Yeah. And
Yeah,
I
because
do. Yeah.
no, go ahead. Please finish your thought.
Because I do think because the rates market is more driven by the Fed. It's not like in the stock market where you can have a valuation multiple going up by 10x, and it doesn't really matter. These ranges represent real bond yields, and those bond yields are represented like really what the market is expecting the Fed to do. So there is a lot of fundamental factors at play, and a lot of that is macro-driven, etc. Price of oil coming down, causing a deflation, all that stuff. So this won't be. So I think with rates, it has to be a combination of technical and fundamental. Whereas with cryptocurrency stuff like that, it could be more to do combining liquidity with technical analysis and stuff like that. So it's a host of reasons at the moment.
Yeah, but to your point, when we get the initial, I know there is that Fed, but then
Yeah.
Fed, if you take the Fed aside, if you just consider the fear of recession is coming, then my sense is that people are going to fly for safety, right? And treasury is definitely one vehicle that's considered like a safe vehicle, right? Apart from maybe precious metal, gold, maybe Bitcoin, but I don't know. That's just my thinking. And then that may be, well, the Fed may be slow to cut the rate, but if people are fearing that, next month or next 3 months recession, or people the market makers see the recession is on the horizon and it's coming, then there may be that flight to safety. That factor, I think, is also going to drive the price.
Yeah. So basically, is it like a sentiment of front running expectations?
Sentiment, yes, exactly.
Yeah. I do think that so actually one thing I did want to caveat for the 2007-2001 analysis is because if things have happened in the history, it's actually really and people are kind of start looking at it. And let's say the entire market agrees with this 2007 analysis and saying we are in that regime. People are not going to sit and wait for the market to rally to end of October and then start selling. They'll be trying to front run it. And we've seen that with seasonality as well. September seasonality is typically weak, but people at the beginning of the month because everyone knew September seasonality is weak. So a lot of the fall actually happened in the first 4 days of trading days of the month. So I definitely think there will be a degree of people trying to jump the gun, and things can move earlier and move earlier. So I think the technical, like watching on a technical level, is really important, and then looking at liquidity, and actually, I think to your point, I think even the data, the macro data, it probably wouldn't take much to scare the market. Let's say unemployment rate, it used to take, going from 4.2 to 4.6 to scare the market. Now probably only takes 4.2 to 4.4. So I think there could be a lot of that. So we just have to keep on watching the price action. Yeah. And also, and also I think the ETF fund flows will be quite helpful. Because if we are seeing large inflows in the treasury ETFs, that could be a sign of people trying to, actively jumping the gun or looking to hedge at least.
Yeah, that's a good point. The fund flow is a good indicator.
Yeah. So I'll update that one daily. So we can just keep on tracking it. So moving on to Bitcoin. For Bitcoin, I'm bullish right now. I'm bullish. So we haven't quite broke this wave 1 high to really confirm we're onto this wave 3. But so just looking at the hourly chart. So first good thing, we didn't really touch this box I highlighted. So we're quite far away from it. And it's gone straight up and it's tested this, it's got broke through and retested this support level as well. So all of that suggests to me it's very bullish. No reason to think it will turn, but you know, as with Bitcoin, it's actually the short term is actually really hard to map out because it's just so volatile. And for me, I think if we got wave 2 here, and I think we can get wave 3 here, wave 4 here, and complete the cycle. We'll complete the large degree wave 3 at 83,000. And the reason I've got this quite high than normal is because of on the micro count. If you look at this wave 5 waves up, even up to here, I thought maybe it would retrace, and it looked a little bit like 3 waves up. But actually, I think we're gonna break. We've broken above this, so this should be like 1, 2, 3, 4, and the final wave getting to the 1.618 extension. We get a pullback, and that should give us an overall target. Overall target to here for this wave cycle 3. So I'm quite bullish right now. If you haven't got in yet, so if I didn't get in, I have to rephrase this. If I didn't get in yet, I will probably add on the next pullback around 60K. I think the longer term has a lot to offer. And the reason I think longer term has a lot to offer is not just because of this chart in terms of technicals. It's because if you think about what's going to happen after the election, we have either Trump or Harris, and Trump is very bullish on Bitcoin. And I think he wants to make Bitcoin to include Bitcoin as part of the government reserve. And it's, I've seen a lot of people criticizing it on Twitter, saying he's really dumb, but actually it's quite clever because it's really clever because the US is the most, the US dollar is the foreign currency reserve of all the other nations, and also gold, right? If the US adopts Bitcoin as part of a reserve, whatever you say about Bitcoin as illegitimate or it's like a Ponzi scheme, whatever, is the fact that the US government adopts it legitimizes it. And I'm writing a piece on Ethereum right now. It will be published tomorrow. The difference between Bitcoin and Ethereum is that Bitcoin is way more decentralized than Ethereum, which is led by the Ethereum Foundation and a core group of developers who have really outsized influence on the rest of the community. Whereas Bitcoin is much more decentralized. And a lot of the big, because China has banned crypto mining, a lot of the big farms are actually now in the US. Not exclusively in the US, but in the US. And actually, so if the US does adopt it, it could legitimize Bitcoin even further. And what's going to happen is that the US buys this stuff and it goes up substantially, and they could just pay back the treasury, the debt deficit, without actually doing anything, without actually needing to cut spending. Because it's almost like influencing the market to your own advantage. So actually, I do think it's a quite rather clever plan if he does it. It will be really controversial. I don't know if the Congress, whatever, who needs to ratify the whole thing, would actually allow him to do it. But of course, but I do think it's a quite good plan.
Trump can do an executive order and buy Bitcoin.
Yeah, so that's one very bullish scenario. Trump gets in the office, ratifies, and lets Bitcoin become a reserve currency. My probability on that is probably less than 50 because it's probably really difficult to make that legitimate through in terms of bills and stuff. But if you think about fiscal spending, right? Trump, so Biden and Trump each added $7 trillion of deficit. And I think Harris, when it comes to Harris or Trump, neither of them really have an interest of reducing that government spending. No one's really said they're going to cut the deficit. Obviously, Trump says they're going to tax, increase tariffs with other nations by 10%, China by 60%, which should increase revenue, etc. Well, we're going to wait to see because it will cause retaliation, also GDP, slow down GDP growth, because US companies exporting abroad will get affected. And then you have the Harris plan of raising corporate tax above from 21% to something like 25%, whatever, which increase tax receipts, but might reduce productivity. Also, it will definitely reduce the free cash flows of companies, right? So that could be a headwind for stock market, but also lower GDP. And secondly, she's going to spend more money on health care, etc., and also housing, affordable housing. All of that requires large government spending. So what's going to happen is that the debt deficit will go up, and the US Treasury is already needing to raise debt just to fund its interest expenditure. It will go up, and the longer term yield, like 20 to 30-year bonds, will lack demand because the Treasury has to issue a bunch of 20-year, 30-year bonds. Even though it's at lower rates because of rate cuts, they'll flood the market with those bond issuances. Investors will not be too happy in, buying those bonds and seeing because of the flood risk, right? So when there's an imbalance, there's too much supply and low demand, the price will drop and yield will go up. So whoever buys it will risk yield going up and price going down, like Silicon Valley Bank, etc., did, facing defaults. And so no one really wants to do that. And what's going to happen is that it might cause a market tantrum. So the longer term yield spiking at some point and destabilizing financial conditions. Obviously, the stock market could crash, etc. By that point, the Fed will have to come in and start expanding its balance sheet again using quantitative easing, right, and pouring liquidity into the market. So this is why I think if China stimulus starts now, the Fed probably doesn't start this year, but at some point, maybe in 2 years' time, or even end of next year, they might really have to expand the balance sheet again, and that is really favorable to risk assets. So in the long term, I do think things like gold and Bitcoin should rise on the back of it. Silver really depends on whether we have a recession or not. If we have a recession, silver is a commodity, it will fall with copper and lead, etc. Otherwise, silver should also go up. So that's my fundamental analysis. We don't know what the plan is, how much deficit they will add in the next election, after the election, next government. But if you just do the math from the past two cycles, we had $7 trillion spending in each of the previous two terms. I don't see why we don't spend even more, just to fund the interest rates. Maybe lower now, but we might have to even issue more debt in the next term. So that's my thinking. And even if we go back to TLT, it could very well be we get to this point, recession, and yields go lower, and then the longer end the stuff, because of the flood in debt issuances, this could go down because of it, and yields go up, and this falls. We don't know, but I definitely think that's more than 50% chance happening. That more likely than Bitcoin becoming an official reserve. But both scenarios favorable. So someone requested IBIT, which is the iShares BlackRock iShares Trust. So the conversion rate is one Bitcoin. the ratio is 1757, and I've mapped out the move, similar Fibonacci levels. I see wave 5 ending at around 54 to 55, I think. So yeah, so I think still very bullish. It's actually shot above this wave 1 high, which is very bullish. So I think we can get wave 3 around 46, pull back to 40. This pullback may not be that, may be quite shallow because the wave 2 pullback is quite steep. And in early wave theory, if the wave 2 is steep, wave 4 tends to be shallow. It could be something like this. Or if the wave 2 is shallow, wave 4 tends to be steep. Just translate into market psychology. If we had a really shallow run up, meaning everyone's bullish, at some point people are going to think, oh, this is the top. Okay, well, we're going to sell. And that becomes a very heavy bear trap, and we'll have a final leg up. Or if this exhausted the bears at the beginning, there's a lot less resistance going up into wave 5. Gold, I do think gold has topped in the near term. And the next pullback would be in the 210, which is around 15% pullback, which is a lot. But the reason I think it's gone up is because if we just do the counts, if we just do the counts from here, wave 1 to this wave 2, wave 3 between 1.38 and 1.618, wave 4 very standard to 210. Sorry, wave 4 should be here to 211. It's not ideal. Wave 4 should be here. And then wave 5 shouldn't be significantly above 2. I mean, it can get to 255, but I do think we're very close to that end. And again, if we look at the subwaves in this wave 5, wave 3 is similar, 1.38, 1.618. Pull back to just above 1, and again, we're pushing above 2. And so both this smaller degree and the larger degree look extended. And if we look at even the larger degree, wave 3, this end of wave 3 would mark 1.618, which is a very standard extension for wave 3. We can fall back to somewhere over here. It could be 227, anywhere between 215 and 227, and then we have final wave up 270. So longer term, I'm still bullish. Just like I said before about if we have recession, etc., or large deficit. But in the short term, I do think this has exhausted in the near term. This has been a very steep run up, so it's quite natural to have a pullback. Silver has done very well. It's much more bullish than I thought it would be just last week. We entered the trade, I think, at 26. We had a 1-2 pullback. We're now wave 3 targets of 30.5. We're very close to that. So once it gets above 30, I don't mind taking profit. And then I think we have a shallow wave 4 and wave 5 at 33-ish. And just to look at those levels in terms of Fibonacci. So wave 3 is something like 1.38 to 1.618. And then we get wave 4 pullback between 0.786 and 1. And then wave 5 somewhere around 2. It could be lower than this. So LSLB has done very well. I think it's basically playing catch up with gold. And if we look at the I don't have gold silver ratio. Yeah, do I have it? So over here it means gold is expensive relative to silver. So silver essentially was catching up. It means now gold can only one ounce of gold can buy 82 ounces of silver versus 90 before. So if you look at that, we're kind of in the average area now for the past 2 years. I will talk about Bitcoin versus Ethereum tomorrow as well. But in the long run, very long run, I do think gold should outperform silver and Bitcoin versus ETH, because the market tend to congregate towards the harder currency, the better store of value. I think silver has its uses, industrial uses, for example, and Ethereum has its uses for the Ether has its uses for Ethereum network. But in terms of long-term store of value, I would prefer gold and Bitcoin than silver and Ethereum. Apple, we're just going to quickly go through Magnificent Seven, and we're going to go through SOXX and KWEB as requested. So Apple, the change has been that. So I expect this to be an ABC down. But I just want to point out that there is an alternative bullish path, which is this could be a one. So this is a B wave finishing already for this C. And we have 1, 2, 3, 4 going up already. How we can confirm is basically breaking above this wave A top, which is not that far away, which is not far away at all. So if we break above it, wave 3 is underway, we can just play the subwave and set up a trade. But my main path is still, I still expect a turn down from here, essentially. I don't know how the narrative will play out because Apple iPhone 16 has just been launched. I think sales has been just normal. They haven't launched Apple Intelligence yet. So I think the next quarterly meeting earnings will be interesting in terms of like getting the management feedback on when are they going to, what's the rollout going to be. The reason, so basically what Apple is planning to do, first, they cannot launch Apple Intelligence in EU and China at the moment. EU has a Digital Market Act where privacy protection, you can't, essentially pull user data and send it to ChatGPT, etc. So, but I think that can get resolved next year. There definitely should be some sort of resolution. China is much more difficult. Basically, especially if we get into trade war 2, and China is favoring things like Xiaomi and Huawei versus Samsung and Apple. So, and these are big markets to handle. So that is a headwind. And also, Apple is doing staggered rollout for the AI in English-speaking countries first. And so it will be in English first, US first, and then going to like UK is not in Europe, I think. Sorry, it's not in EU. So I think UK will get it. And then you'll get, they will do other languages like Japan, etc. And they basically, because the Apple Intelligence is the first time they've done such a big upgrade. And a lot of startups have really messed up on the hardware play for AI. So Apple has been really careful trying to do as much testing as they can. So I think this move up can take a little time to gather steam, especially I think most of that should happen in the first half of the second year rather than this year end. So yeah, so that's my expectation for Apple. Amazon, not much different. So I think we have 1, 2, 3, 4, 5. Don't really have much more to say about that. I still think we should get a pullback. So previously, what happened is that we tried to break above 200, and Jeff Bezos starts selling into it. He has an order at 200 to fund his yacht or Blue Origin projects, whatever. And the market hit wall, and it came down. Amazon is quite fairly valued, I would say, among the Magnificent Seven stocks. I would say valuation-wise, Amazon, NVIDIA, and Google. Amazon's best, probably NVIDIA and Google after that. So I would still ideally want to get this pullback. It might not be as steep as this. It could be much shallower. But in that case, the target will also be higher. So I'll move this accordingly once we get the pullback. Google, so the alternative is that we could have topped, but I'm still expecting a larger correction. valuation wise, I think it looks okay. It's fair. It's not cheap. It's fair compared to peers. It's okay. We had 5 waves down. So the reason I'm bearish is because we've had 5 waves down into this wave A, 3 waves up into this wave B, and now it looks like we're going to have 5 waves down again. I could be wrong, and I will reassess if we get a bigger bounce over here above this B, and it could be that we're starting a new wave 3 cycle here. But even if it bounces above B, I will still wait for a 1-2 setup. So I'm not in a rush to buy Google at the moment. Hopefully, it's not my famous last words. Meta, we saw miss the trade at the beginning of the August. It never quite got to our target. I think it will move towards wave 3 at 600. So it's just here to, if we get there, but I think the chances are we'll get to wave 3, target 600. Microsoft, we have 5 waves down here for wave A, 3 waves up for wave B. So I'm still expecting wave C. I think Microsoft is quite expensive valuation-wise. But long term, I'm still obviously bullish. So I do think there is valuation-wise and technically it has room to correct. What could change my mind is that if we get 1, 2, and then we'll have 3, 4, 5. Obviously, the price has run away, but the 5 waves up is really important to form a bullish setup. And we wait for 1, 2, wave 2 drop, and then we can play something like entering here and play for the wave 5. Nvidia, nothing has really changed. I know some people are much more bullish for Nvidia, valuation-wise, justified given this growth. Doesn't look that expensive in terms of forward earnings versus forward growth, but technically, we've had 5 waves down. I mean, all of this is 3 waves up, 1, 2, 3 here. So I don't feel like we've got, and over here as well, it's not really clean 5 wave up. So it does feel more bearish at the moment, and obviously breaking above B or breaking above B will suggest I'm probably wrong and we have to reassess. But at the moment, it's largely within what I expected. So this retrace is like it's like 70 or 80% retrace of this, which is still within the normal range. Tesla has been very bullish. So the reason I missed this trade, and I'm a bit annoyed that I missed it, and I have to admit I missed it, is because this wave 2 was fairly shallow compared to for this entire wave. So what I did expect was I thought the market would turn further down here and give us a C wave, which would give us a really nice entry at 200. It didn't. It just kind of carried away and made a new high. And all of this happened within the past week, essentially. So now, if we look at this new wave 1 here, wave 3 at 1.618 retrace and just above 1 for wave 4. And now wave 5 pushing above 2 extension of wave 1. Very standard place to be for Tesla. It could push to 260, but I would take profit myself if I was in the trade. And congrats if you are in the trade. And I'm basically waiting for this pullback around here in the 228, 230 area. Longer term, I'm very bullish and justifiably bullish in terms of fundamentals. I think Tesla could get up to 400 in this wave 3 of larger degree wave 3. So what Tesla needs to do, the grand plan for Tesla, is they have to move away from having car production as its main source of revenue. So car production is 90% of its revenue, and it's got energy storage and all that stuff, FSD. But what they really have to do is robotaxi and leasing the cars, which is a higher margin, and then that robotaxi FSD story should get us to wave 3. And it doesn't actually have to happen. I mean, a lot of this could run up into the expectation. The advantage for Tesla is that once the software updates, every Tesla can become a robotaxi straight away. It's not tested how many people would want to actually lease out their Tesla. Maybe people will buy one and lease out and use the other one for themselves. I wouldn't be that comfortable putting my Tesla as a free, sort of like a non-human intervened robotaxi for others and using the same car myself. So all of that narrative could drive this action. And Elon essentially openly said that if you're buying Tesla, you're not really buying the car production, the future free cash flows from the cars. You're buying the robotaxi, FSD, and robot humanoid market, and that's another big market. The robot humanoid market is worth 14 trillion. If you think about how many, so for that narrative, so I'm telling you narratives now, right? It might not play out, but I'm just telling you what the narrative would be for Tesla in 3 to 5 years' time. So when it happens, we shouldn't be surprised. We know the robotaxi narrative. The robot humanoid narrative is that if you have a worker, human person who works 40 hours a week, has to rest, take coffee breaks, have lunch, go home, commute, all that. Instead, you put a robot in. The robot can probably work 80 hours a week, all right? And you can work on weekends, but you probably need humans to supervise on weekends. You can work you can work 80 hours a week. It doesn't need lunch break, etc. It can lift productivity by at least 100%, right? So if you think about the productivity gain and the value it generates for the wider society globally, and then you say, okay, Tesla can have a take rate of, let's say, 10% to 20%, then that's like a $3 to 5 trillion dollar valuation uplift. So that's kind of the bigger picture that Elon Musk is going for. He's a really great storyteller, and everyone believes he's a genius anyway. He's done all the impossible things. So there's no reason to doubt that he won't be pushing that narrative that hard into this wave 5. So sorry for rambling on. And just gonna finish off CRM. I'll expect short-term correction here, and we have a trace set up. I'll be wrong if it goes above there, then I'll have to look at it again. And then SOXX. Okay, SOXX. I talked about SOXX before. I said my primary expectation is bearish, just because the way this has gone down 5 waves, and this was not a very clean 5-wave. It's like a 3-wave up, and then 5 waves down here. So it does make me feel the primary direction is down, and it will be significantly. I'll be right essentially as soon as this breaks this head and shoulders, this neckline here, and moving into wave 3. It hasn't done that yet. This primary path can be invalidated if it moves above this wave B, and we can have essentially this correction finished straight away, and we'll have 1, 2, 3, 4, 5 wave up to 360. I think the longer term direction, we should get to 360 anyway. It's just the near term path, whether we take a bearish path down and then up, or we just move immediately up. As long as this neckline holds, this support holds, I think the chance is quite equal at the moment. So I would just let the market decide whether it's going to break over. So if you decide to short, let's say you disagree with the bulls, I think this wave B high is a good place, or a couple of percent above wave B high is a good place to stop out, and this wave 3 low is a good place to take profit. And finally, KWEB, China Internet Shares. I put this in the Google Sheet before. It's a really tricky situation they're in, because if you look at the history, we had essentially 3 waves up, which suggests this is a corrective wave. And then we also had 3 waves down, right? So now we have a bounce here, and that could be a wave 1 and 2, ABC2. That all makes complete sense. And we have wave 1 and 2, and we're looking towards a breakout on wave 3 high here, as bracket 3 high, and the circle 3 high here, 70, and then get towards the all-time high over here, 84. But there's every chance that we're actually just in a wave 4 high bounce, and we get to things get worse essentially before it gets better. And things can get worse because Chinese stimulus is far not enough. The real estate is in really big wobbles. So that all of that could happen. This wave 4 bounce doesn't overlap with wave 1 yet. So it could definitely happen that we don't have enough of we're just in wave 4 and wave 5. So we have this channel here, the support and resistance. With a break above this, I think we're going towards a more bullish path. I think if we go through here, A, B, C for wave 4, it's pretty steep for wave 4. So I don't really expect that. But if it falls through here, then there's every chance we get 5 here. So again, it's something I would let the market decide. If I go long here, I would put a stop here and I'll put a take profit here, essentially. I'm agnostic at this moment. I think that's everything. A long webinar, 90 minutes. So thank you for staying all the way through. Any questions before we go?
Hey, Eamon.
All right. Yeah.
Question.
Alex, come.
Yeah, this KWEB. So you were saying that right now it seems like at a crossroad, it could go higher, it could also go lower. Is that what you were saying?
So I think, yes. So at this moment, I feel it. So at this moment, I would say, based on this wave 4 reaction, I think the primary path is higher. Mm-hmm. And then if you think on fundamentally, the China stimulus comes comes through. Yeah. What I'm also saying is that there is a chance, we can't rule out this chance of this being wave 4 high and therefore wave 5. So if I'm entering this trade here, I would put a stop near here. If I was to enter trade now, I would definitely put a stop here and not just let it ride below it, because once it breaks through here, there's every chance we can get all the way here before it gets higher. So that's what I'm saying. I'm not saying this is the primary path. I think this is probably the primary path, but there's a chance we can't rule out. And with technical analysis, at the end of the day, it is all judgment-based, because if it's not judgment-based or subjective, then there's only one answer, then all of this would have already happened. If there's only one path that everyone thinks there's just this path, then the market would have already filled out this path before I get to fill it out. Ultimately, everyone has a different opinion and it aggregates to this point. So I definitely wouldn't want to rule out this chance. I think we can, but I do like to think that we can move up here. Yeah, that's what I'm saying. Yeah. Does that make sense?
So, yeah, it doesn't. So your primary path is in black. Your alternative is in red.
Yeah.
Okay. And could you please go back to the SOXX chart again?
So which chart?
SOXX, the semiconductor.
Oh, right. Yes. Yeah.
Okay. So here you have both red and black. So here, which one is your primary? So I'll just write this down so I can share later. With all my charts, black is the primary wave and red is alternative. Yeah. Okay. So and I just want to stress, I do think they are quite close at the moment. And the reason I've assigned black to be the primary path is because of the way this has come down 5 waves. And this hasn't been a very clear 5 wave up, neither has this. So if it breaks above this, then I can say, okay, I think the red wave probably takes precedence. But for now, I still read it lower. Yeah. So if I were to go long here, I would definitely have a stop below this support. And if I was going short here, I would definitely have a stop slightly above this B. Yeah, so with all my charts, black is the primary wave and red is the secondary. Yeah. Oh, okay. Okay, that's helpful. Thank you, man. Good webinar.
No worries.
A lot of
Okay.
good intel.
Okay, so I think we finished here. So thank you very much for coming to the webinar today. Now my next piece is Ethereum, which will be published tomorrow. And then after that, what I'm going to do, I'm going to summarize the sector plays in financial stocks, payments, asset management. So I'm going to do the opposite of what I did for Magnificent Seven. I'm going to compare all the stocks first, valuation and technical analysis. And then I'll pick out the interesting ones because there's so many of them. I don't think it's worth everyone's time reading stuff that don't have a setup. So I'll pick up the ones with a setup and then I'll publish the deep dive after. So it will be the opposite flow of what I normally do. So yeah, thank you very much. Any questions, pin me on Slack. Thank you.